China's latest effort to shore up stalling growth has failed to impress. Commercial banks trimmed their loan rates, but the cuts were smaller than anticipated and smaller than what economists say is needed to revive growth. Traders too were underwhelmed, sending stocks lower and the yuan weaker following the announcement. The one-year loan prime rate was cut by 10 basis points to 3.55%. Most new and outstanding loans in China are based on this one-year rate. The five-year rate was reduced by the same magnitude to 4.2%. It serves as a reference for the country's mortgage rate. Many economists had predicted a bigger cut of 15 points to help sentiment in China's already ailing housing market. Still, it's the first such easing in 10 months. These rates were designated by 18 commercial banks in China, or they usually track medium-term lending facility rates, which saw their first cut since August 2022 last week. Analysts are expecting more reductions later this year.
I think there's still a bit more coming, particularly in terms of trying to support the property market and perhaps some initiative concerning regarding the consumption, trying to kind of spur consumption. But I think we will continue to expect that the measures would be very targeted and selective, as opposed to having a big bang approach.
The modest cuts disappointed yuan traders who were hoping for a policy boost for the housing market. Both the onshore and offshore yuan building on earlier weakness in the run-up to this decision. You can see that US dollar to CNY and US dollar to CNH there. Meanwhile, Chinese stocks drawing little comfort from the cuts as well, except for the Shenzhen. Now, that one went up 0.28%, but the Shanghai, that was down almost 0.5%, and the Hang Seng down just over 1.5%. Tech firms, which are susceptible to higher borrowing costs, taking the brunt of the selling, while property developers also ending lower.